These are the items that we need to perform to address other disclosures or accruals that are not picked up elsewhere. They also tend to be items when we try to rely on as much hindsight as possible to get our conclusions correct. After all, our report doesn't usually come out until a couple of months after the year-end date. So it behaves the auditor to perform procedures utilizing as much subsequent information as possible to the extent it also has to substantiate the year-end balances. One type of R that requires significant judgment is contingent liabilities. A contingent liability represents a future payment of which the outcomes and amount are uncertain at the year-end date. Some common examples include lawsuit, tax disputes, and guarantees provided to others. These sorts of contingent liabilities give rise to financial reporting issues in the form of recording provisions and incremental.
The procedure performed by the auditor for contingent liabilities includes, first of all, making inquiries of management. There's a standard checklist of questions to ask where the auditor and the CFO sit down and have one last closing discussion. Secondly, reviewing any correspondence on such matters. For example, notices of assessment or reassessment from the tax office. Thirdly, reviewing minutes of board meetings. Board meetings are often where the really good stuff gets debated. Fourthly, analyzing legal invoices, as this often reference pending matters. And fifthly, sending a legal letter to all the lawyers in which the company has a relationship. Legal letters are standard procedure for auditors, and the lawyers have a prescribed format for responding. The legal letter will confirm the existence of potential claims, the nature, the status, the amount, and the likelihood of loss. So that covers of the contingencies, the auditor also need to consider subsequent events. You should remember that there are two types of subsequent events. The first is those events that have a direct effect on the financial statements and require adjustments. For example, perhaps we have a valuation concern over a particular asset. If that asset is sold subsequent year-end, then we might be able to use the sale price as evidence of the valuation of the asset at year-end.
The second type of subsequent event is those that do not have a direct impact on the year-end financial statement, but for which disclosure is required. For example, if one of our clients' hotels burn down after year-end, but before the report is released, this should be disclosed in the financial statements. The procedures for identifying subsequent events are similar to those used of contingencies, so auditors will conduct the two simultaneously. Additionally, the auditor may look at internally prepared financial statements subsequent to the year-end date to identify potential issues. The letter representation is one of the last pieces of evidence is gathered by the auditor. This letter is typically prepared by the auditor, but it's written as if the client wrote it, and it's printed on client letterhead. This 6 or 7 page letter basically summarizes all the material representations made by the management throughout the audit. It is signed by the CFO and CAO, and sometimes even the controller. It's not the strongest piece of evidence available, but it is considered a standard audit procedure. It's intended to reinforce to management the representations they have made to the auditors, either explicitly or implicitly through the financial statements they have prepared and represented.
The final review of the file will be conducted by the engagement partner. For high-risk engagement, a second partner or a technical review partner may also be brought in to review some or all of the audit file. The ultimate question is whether sufficient appropriate audit evidence has been gathered to support the auditor's opinion. One key consideration will be to review the accumulation of unadjusted misstatements. Different firms call this worksheet different things. For example, I often hear my auditors referring to this as a SED, or Statement of Audit Deficiencies or Differences. Auditing is full of wonderful acronyms that only make sense to those in the Secret Auditors Club. The point here is to review the misstatements that have been accumulated throughout the audit fieldwork and make an overall comparison against materiality. Are you shocked that the auditors would find any misstatements at all? You shouldn't be, as this is very common. The auditor needs to keep in mind any carry forward errors from last year that would impact this year's numbers. This is often a point of confusion for new auditors.
So let me explain by way of an example. If inventory is overstated by say of $100,000 at the end of last year, which by the way would mean that gross profit last year was overstated by the same amount. This error will carry forward to this year and should reverse itself when this inventory is sold. When our overvalued inventory is sold in the current year, it increases our cost of sales, which understated our gross profit. So, do you see how those opening errors can reverse? Next, we have disclosure checklists. Disclosure checklists are horrible things that can literally go on for hundreds of pages. But their purpose is to simply ensure that everything that should be disclosed under GAAP is disclosed by the client. So, during the final evaluation, the partner will review all the work performed by his staff, and there are 3 reasons for this. Firstly, to evaluate the performance of inexperienced staff, the junior auditors fresh out of school. I told you the partners never trust you entirely. And remember the GAAS standard we talked about way back at the beginning of the course, the one about supervision of staff? Now, you see its relevance. Secondly, to make sure the file meets the firm standards, not to mention GAAS and PCAB or PKOB.
Thirdly, to counteract the bias that can creep into the auditor's judgment, the audit field staff spends considerable amount of time working with the client, which can lead to bias. The partner's involvement offsets some of this bias. At this point, the partner will prepare review notes and this gets sent back to the audit team to clear. Your goal as an auditor is typically to receive back as few notes as possible. Some review notes are easy to clear, say for instance, asking you to document the word you performed better, or perhaps asking for clarification on particular aspect of file. Other review notes may require you to return the client's premise and conduct more extensive procedures, which is difficult to work on. The final steps of the audit are to draft the auditor's report, any management letters, and prepare the communication to the audit committee. Now, the communication by the auditor to the audit committee will contain a summary of the major issues they had to deal with during the audit, as well as their concurrence or disagreement with management on these matters. The auditor will typically list any significant but not material statements they identified. And finally, the auditor will identify any matters that remain outstanding as the date of their presentation. The auditor's report will only be released when all items have been received and the board has approved the financial statements. So finally, we have finished our audit.